Welcome to ZZ Financial. We are dedicated to providing the most accurate, valuable, and timely information and analysis.
And good evening, everyone.
Yeah.
It's Wednesday, August 20th. We're just past 11 p.m. Eastern Time, which makes it 8 p.m. out on the West Coast.
What an interesting and, well, multifaceted day it's been in the financial world.
It really has. I'm looking at these headlines, and honestly, I'm really curious about how they all connect. What's the latest? What's really grabbing your attention right now in the news? And maybe more importantly, how can we tie these different threads together?
You know, you're right. There's so much happening that at first glance, it feels disconnected, doesn't it? We're looking at everything. Potential next moves from the U.S. Federal Reserve, the wild ride of tech stocks, then all the way over to intriguing shifts in Asian markets, and even things like global shipping trends. Quiet hum, as you said.
Exactly. It feels like a lot of separate events. Right. But our mission today, as we go through the sources you've shared, is to really deep dive into each one and try to connect those seemingly separate pieces into one cohesive, hopefully understandable financial story for you.
Okay, let's do it. Let's untangle this web and make sense of it all. All right, let's unpack this first piece. The buzz among financial analysts seems to be growing louder. The U.S. Federal Reserve, the FRB, is increasingly expected to resume interest rate cuts, and soon. This feels like a pretty significant shift from where we've been, doesn't it?
It absolutely is a pivotal moment, you could say. And the consensus among many experts, it points in this direction. Kevin Flanagan, for instance, he's head of bond strategy at WisdomTree. He's projecting the Fed could implement maybe 2 to 3 rate cuts in 2025.
2 or 3 this year alone.
Yes. And he's even put a very high probability, over 80% on a 0.25% cut coming as early as September.
Wow, September, that's close.
It is. And he doesn't see this as just a one-off thing. He anticipates, I think, 2 additional cuts in 2026 as well. So we're potentially talking about a multi-year path of easing policy.
That's quite a forecast. And it raises a really critical question for me. For so long, we've heard inflation being the primary concern for the Fed. But you're saying the reasoning here really centers on the shifting sands of employment data. Why is the employment situation suddenly the most crucial indicator, even more so than inflation, for the Fed's decisions right now? What's changed in their focus?
That's a really important distinction to make. And yes, while inflation absolutely remains vital, you have to remember the Fed operates under a dual mandate. Maximize employment and maintain price stability.
Yeah, the dual mandate.
So think of the employment situation like the engine of the economy. If it starts to falter significantly, it impacts everything: consumer spending, business confidence, overall growth. When the job market shows signs of weakening, it signals the economy might be slowing down, maybe too much. In that scenario, the Fed needs to step in, use rate cuts to stimulate activity, even if inflation isn't perfectly back at their 2% target yet. The key insight, I think, is that the Fed, right now, sees the risk of an economic downturn from a weakening job market as, well, more immediate, more impactful than the risk of inflation really getting out of control again.
So it's a rebalancing act.
Exactly. A delicate rebalancing act, not necessarily a crisis, and that's a subtle but crucial distinction.
So the health of the job market is now their leading indicator. Okay, what does that softening U.S. labor market actually look like in the data we're seeing? You mentioned rebalancing, not crisis. So is it like a gentle slowdown, or are there big red flags popping up?
Well, the numbers, they do offer a clear narrative. For instance, July non-farm payrolls, that's the measure of people employed outside farms and government, they fell short of what the market expected.
Okay.
And what's more, both the May and June figures were significantly revised downward. That points to a consistent deceleration in job creation.
Revisions are key sometimes.
They really are.
Yeah.
Now, it's true. U.S. retail sales for July did show resilient consumption. People are still spending, which shows some underlying confidence. But that spending, it just wasn't strong enough to completely cancel out the softening we see in the employment data. That seems to be taking precedence in the Fed's thinking right now.
That makes sense. So people are still spending, the engine's still running, but the job market is cooling. How does the Fed weigh those two, well, seemingly contradictory signals? And what does this softening look like on the ground? Is it like a sudden stop or more of a gentle easing off the gas?
It's a great question because it really captures the nuance the Fed is grappling with. New York Fed President Williams actually described it recently. He called it a low hire, low fire dynamic.
Low hire, low fire.
Yeah. Think of it like a cautious business owner. They're not aggressively hiring new staff like they might during a boom, but crucially, they're also not laying off existing employees in large numbers.
Okay, so caution on both sides.
Precisely. Companies are being more conservative with expansion plans, but unemployment isn't worsening significantly. The benefit of this, which maybe sounds a bit mundane, is it allows the economy to cool off. It helps the Fed justify rate cuts without triggering those painful mass layoffs that usually come before a full-blown recession.
Ah, so it avoids the big shock.
Exactly. It's that delicate rebalancing again, not a crisis. And that's subtle, but really crucial.
I'm following you there. It's more of a gentle deceleration then, rather than, hitting a brick wall.
Exactly right. And just to give some context, despite this softening, current weekly U.S. initial jobless claims, those are the applications for unemployment benefits, they remain quite low compared to what we've seen during past recessions.
Okay, that's a good sign.
It indicates that while the labor market is slowing, it still has a degree of underlying resilience. Consequently, the risk of a U.S. recession, at least in the immediate future, is considered to be pretty small.
Okay, so the Fed might cut rates. The job market is resilient, but definitely cooling. What's the expected impact on the bond market, specifically thinking about the yield curve and long-term rates?
Well, following these anticipated rate cuts, the yield curve is widely expected to steepen. Now, this term steepening yield curve, it refers to a situation where the difference, the gap between short-term bond yields and long-term bond yields widens.
Okay.
We're predicting that the yield on the 10-year U.S. Treasury note, which is a really key benchmark for long-term rates across the economy, influencing mortgages, corporate borrowing, everything, that could fall to around 4%, down from its current level of about 4.29%.
A steepening yield curve. That's one of those phrases that often trips people up, but it sounds like it tells a really crucial story about the market's expectations. Could you maybe help us visualize what that actually means in practical terms, perhaps with a helpful analogy?
Absolutely. Let's try this. Think of the yield curve like a seesaw.
Okay, a seesaw.
The short end of the seesaw represents short-term interest rates. That's the end the Fed directly pushes down when it cuts rates. The long end represents long-term rates, like that 10-year Treasury yield. These are influenced more by market expectations for future growth and inflation down the road.
Got it. Short end, Fed control. Long end, market expectations.
Exactly. In a, let's say, healthy economy, or when the market expects future growth and maybe some inflation later on, the long end is typically higher. You get paid more for tying up your money longer. When the Fed cuts short-term rates, they effectively push down their side of that seesaw. Now, if the long-term rates either don't fall as much or perhaps even rise a little, maybe because of renewed optimism about growth or worries about inflation returning later, then the seesaw tilts more steeply upwards from short end to long end.
Ah, I see the tilt.
It's basically a signal. It says that while the Fed is easing policy right now, the market might still anticipate, reasonably robust economic activity or maybe higher inflation further out. That makes those longer-term bonds relatively more attractive, or at least demands a higher return for holding them.
That seesaw analogy really makes it click. Thank you. Now, what about tariffs? We know they've been a significant factor in trade discussions. Are they still contributing to inflationary pressure, and how does that factor into the Fed's thinking?
They are, yes, but the current thinking, the consensus, is that U.S. tariff policies are contributing to price increases at a relatively slow pace. A manageable pace.
Okay, so not a primary driver right now.
Right. It's not causing excessive alarm or concern that would sort of override the employment data or the broader economic picture for the Fed. However, it is worth noting that the July U.S. Producer Price Index, the PPI,
that tracks prices producers get.
Exactly. It tracks the average change in selling prices received by domestic producers. That did suggest these tariff policies are increasing corporate burdens. It's a subtle concern for the Fed because it impacts business costs. So they'll likely want to wait for the August employment figures and the consumer price index, the CPI data, that's consumer prices, before making any firm decisions on rates.
Okay, waiting for more data. Makes sense. Then there's the famous Jackson Hole Conference. That's always a huge event for market watchers, isn't it? It's happening August 21st to the 23rd, and Chair Powell is scheduled to speak on the 22nd. What's the market anticipating, and what do you forecast his likely stance will be, especially given all this data we've just discussed?
Oh, the market is absolutely on tenterhooks for Chair Powell's speech at Jackson Hole.
Yeah.
There's definitely a strong hope, maybe expectation in some quarters, that he'll directly signal a September rate cut.
But will he?
Well, based on the Fed's recent communication style, he's likely to maintain a cautious stance. data dependent. He'll probably hint at a direction, towards cuts, but heavily emphasize the need to assess all the incoming data before making firm commitments.
So managing expectations.
Exactly. The real risk to be wary of here is if his remarks turn out to be surprisingly hawkish.
Hawkish meaning?
Meaning he leans more aggressively on fighting inflation and seems less inclined to cut rates than the market currently expects. In that scenario, U.S. interest rates could see a significant upward spike that would definitely rattle markets that are already pricing in those cuts.
Right, that could cause some volatility. And speaking of surprising remarks, we also saw President Trump demand Federal Reserve Governor Cook's immediate resignation. That was over alleged mortgage fraud. Such direct political pressure on the Fed is certainly striking. Does this kind of public demand actually sway their decisions? I mean, is the Fed truly as independent as it claims to be?
That's a critical question. It really probes the foundation of the Fed's operational independence. And it's a debate that, frankly, resurfaces quite frequently. While it's true, the Trump administration has consistently advocated for rate cuts, and public pressure from politicians can certainly be loud. Federal Reserve monetary policy is ultimately decided by a majority vote among the participants of the Federal Open Market Committee, the FOMC.
The committee decides, not just one person.
Correct. It comprises 12 members, the Fed governors, presidents of some regional Fed banks. So even if a future Fed chair were personally more dovish, let's say, the broader group of FOMC members largely maintains that data-dependent stance. Their decisions are primarily guided by economic indicators like inflation and employment, not political winds.
So less likely to be swayed by politics alone.
Right. The risk of an extreme dovish shift at the Fed, driven purely by political influence, is generally considered relatively small because of that structure.
I see. So the structure itself kind of acts as a safeguard.
Precisely. In fact, look at the minutes from the July FOMC meeting. They reveal that a majority of participants actually viewed the risk of rising inflation as greater than the risk of employment downside.
Oh, interesting. Even with the softening jobs data.
Yes, it's a subtle shift in sentiment, but it slightly decreased the probability of a September rate cut in the futures markets, though it still remains high, over 80%. This just highlights that while external pressures exist, the internal decision-making process is designed to be deliberative, data-driven, aiming to keep policy insulated from that immediate political influence.
Okay, that helps put the political noise in perspective. So having just unpacked the Fed's domestic tightrope walk, let's zoom out now. Let's see how these U.S. monetary policy expectations and other global forces are rippling through the stock markets. We can start with some intriguing shifts we're seeing in Japan. What's been happening over there?
Well, the Nikkei average, Japan's main stock index, it's faced considerable pressure recently. At one point, it fell over 800 yen, trading down in the low 42,700 yen range. This decline was largely driven by selling in stock index futures and also significant drops in key semiconductor equipment stocks. Companies like Advantis and Disco, they're highly sensitive to global tech trends.
Right, the chip sector connection.
Exactly. Now, August often sees what people call the summer doldrums. Trading volume typically drops off due to holidays. But this August, trading volume is actually unusually higher than usual. That indicates active participation. Many market watchers believe that overseas investors, maybe returning from their summer breaks, are likely engaging in some profit-taking after the recent rally in Japanese stocks.
So it's a mix of that seasonal slowness maybe, but also some big investors just deciding to cash in after a good run. What does that mean for the overall health of the Japanese market? If some of these major players are stepping back, even temporarily, does it signal weakness?
That's a fair question, but I think it's important to look beyond just the immediate profit-taking. Despite this short-term selling, overseas investors generally remain strong buyers from a medium to long-term perspective.
Really? There's data on that.
Yes, we've seen tangible evidence. There were 1.16 trillion yen in net purchases just from August 10th to 16th. That's a substantial inflow, and it speaks to enduring confidence.
Okay, that's a big number.
It is. And furthermore, Japanese companies themselves, they're making concerted efforts to boost shareholder returns. More dividends, robust share buyback programs. Those things fundamentally support market valuations.
Right, giving money back to shareholders.
Exactly. So while there's definitely some short-term volatility, maybe some recalibration happening, these fundamental supports are preventing extreme supply-demand imbalances. They underpin the market's underlying health. It doesn't look like a sign of fundamental weakness, more like a temporary pause amidst a longer-term positive outlook.
That's reassuring context. Now, let's pivot back to the U.S. tech sector. It's been a real roller coaster lately, hasn't it? Especially with all the initial, maybe hype around AI, now facing some serious bubble talk. The NASDAQ Composite Index, heavily weighted towards tech, continued its fall, down 2% over just 2 days. And major tech and semiconductor stocks, NVIDIA, Apple, Amazon, Microsoft, Intel, Micron, they've all seen significant selling pressure. What's fueling this AI bubble fear? Especially when everyone was so excited just a few months ago.
Yeah, it feels like a classic case of enthusiasm maybe outrunning reality, at least in the short term. The AI bubble narrative is certainly gaining traction, and it's fueled by several key reports and warnings.
Like what specifically?
Well, firstly, a recent MIT report delivered a pretty staggering statistic. It said 95% of organizations have not seen returns from their investments in generative AI.
95%. Wow.
It's a stark figure. It really raises questions about the immediate, tangible profitability of these massive AI investments we're seeing across the corporate world. And secondly, even OpenAI CEO Sam Altman, a leading figure in the AI space, obviously,
Right.
he issued a pretty blunt warning last week. He said, AI is entering a bubble phase, and that some investors will lose a lot of money.
That's significant coming from him.
It is. These are serious red flags coming from within the industry itself, not just from outside observers.
That's a powerful combination of insights than actual data showing low returns and a direct warning from a major industry leader.
Indeed. And while it's true that the Q2 earnings from the big tech firms, Alphabet, Microsoft, Apple, Amazon, Meta, were actually quite strong, these warnings, combined with extremely high valuations for some companies. I mean, look at Palantir. Its price-to-earnings ratio exceeding 200 times. Yeah. It's raising legitimate concerns about the sustainability of this current AI-driven rally. Jefferies analyst Brent Thill even suggested that the real acceleration of enterprise AI might not be in 2025, as many seem to expect.
When then?
Maybe more like 2026 or 2027, which implies that current market expectations for early, high returns on AI investments are potentially, well, excessive, as he put it.
Okay, so expectations might be too high too soon.
That seems to be the growing concern. And this skepticism has already taken a toll on the semiconductor sector. The Philadelphia Semiconductor Index, the SOX index, it fell over 4% in just 5 days.
And that index is important because
It tracks the health of the major chip makers. It gives us a real-time pulse on the tech sector's underlying hardware engine. A drop like that signals real concern.
Got it. And it's not just market sentiment at play here. We're seeing government intervention in the semiconductor space too, aren't we? It was reported the Trump administration is considering acquiring shares in Intel, Micron, and TSMC Taiwan Semiconductor, all companies receiving CHIP Act subsidies. That seems like it would create uncertainty, maybe selling pressure, even if the government says it won't interfere.
It absolutely does create uncertainty.
And then there's the other piece. The U.S. government's recent agreement with NVIDIA and AMD for a 15% revenue share on AI chips exported to China, with plans to expand that mechanism. So it feels like the government is trying to boost the chip industry for national security, economic reasons, but it's also making investors nervous at the same time. How do those two conflicting things balance out?
It's a classic dilemma, isn't it? Between strategic national goals and the, well, unpredictable nature of market dynamics. The government's clear goal, with things like the Cheap Adjustment Act, is to strengthen the domestic semiconductor industry, ensure supply chain resilience, maintain tech leadership. Subsidies are a direct tool for that.
Yeah.
However, when you introduce the possibility of direct government stakes in private companies, or mechanisms like revenue sharing on exports, it creates a new, often unpredictable layer of involvement in corporate operations and profitability.
Which investors don't like.
Generally, no. For investors, this uncertainty around potential government interference, even if it's meant to be supportive, it can lead to nervousness, selling pressure. It complicates the investment case by adding a new risk, one that's hard to quantify.
So it's a tough balance.
It's a very delicate balance.
Yeah.
That desire for strategic control versus maintaining a free, predictable market environment that attracts and rewards private capital.
That's a fascinating look at the complexities. So despite this broad tech decline and these interventions, were there any specific tech stocks that actually performed well? Any standouts?
Yes. Actually, there was a notable exception. Analog Devices, its ticker is ADI. It actually rose significantly by 4.9% after its third quarter earnings and fourth quarter outlook both exceeded market expectations.
Oh, okay. Where did they see strength?
They showed strong growth across all their segments, particularly in communications and industrial. It indicates that, not all parts of the tech sector are facing the exact same headwinds.
Good point. What about Palantir? You mentioned its high valuation earlier.
Right. Palantir Technologies. after a pretty steep 6-day, 16% decline, and it was down temporarily about 25% from its peak trade. Chart analysis, technical analysis suggests it might be bottoming out now.
Really? What's the signal?
It closed above its 50-day moving average. That's often seen as a key indicator for medium-term trends, sometimes signaling potential support. So, yeah, there are some glimmers of hope or at least stabilization amidst the broader tech sell-off.
Okay, let's move to some specific company updates out of Japan now. First up, Zensho Holdings. They're the parent company of Hama Sushi, and they face some negative news, right?
Yes, Zinsho Holdings stock fell 3.3% today. Unfortunately, this was prompted by a hygiene incident at one of their Hamasushi stores. A child reportedly felt unwell after consuming ice cream, and it seems there was detergent residue on the container.
Oh dear, not good.
Not good at all. And it sadly follows a similar issue at their Sukiya beef bowl chain back in March, which had already led to a dip in customer traffic. Hamasushi admitted to violations of their operational manual. Apparently, it specifically prohibits placing cleaning tools above freezers or food ingredients.
So a clear operational failure.
Seems so. While there was an initial wave of selling pressure, some buying did emerge later in the day. Analysts suggest that if the company implements thorough, transparent hygiene management protocols, similar perhaps to how Sukiya handled its past incident, it could prevent a prolonged decline, maybe even potentially surpass recent highs in due time.
So crisis management is key here.
Absolutely. It's a stark reminder of how critical operational consistency and, frankly, brand trust are in these consumer-facing businesses.
That's a good point on the potential for recovery. How about Potential, the company behind those popular Bokun pajamas? Their stock had a rough day.
Yes, potential stock plunged quite sharply, 13.66% today. This looks largely like profit-taking, though. The company's shares had surged over 30% in just the preceding 2 days.
Why the surge?
That was after they announced an upward revision of their profit forecast, driven by really strong sales of their fatigue recovery pajamas, the Bikuni line.
So good news led to a rally, then investors cashed out.
Exactly. A classic case of investors locking in gains after a very rapid run-up. The news itself was good, but the market's immediate reaction was to capitalize on that recent price jump.
Understood. And Chugai Pharmaceutical, what was the story there?
Their stock fell after Nomura Securities lowered its target price for the stock, down from 6,800 yen to 6,500 yen, though they kept a neutral rating. Nomura's analyst apparently anticipates a fourth-quarter drop in exports of Hemlibra, one of their key drugs, to Roche, despite strong Q3 performance.
Why the expected drop?
They cited expected holiday factors and also some discontinued products. However, it's worth noting that the full-year sales forecast for Chugai was actually raised. That was thanks to continued strong performance of Hemlibra and another drug, Actemra.
So a mixed bag of news then.
Very much a mixed bag. But the target price cut seemed to weigh more heavily on investor sentiment today. It emphasizes how the market can sometimes zero in on short-term factors, like export fluctuations.
Right. And what about the fast food giant McDonald's Holdings Japan? Their stock was down too.
Yes, their stock fell 1.05% today. This is a direct reaction to the company halting sales of its one-piece Happy Meal promotion.
The anime promotion, why halt it?
It was scheduled to launch on August 29th, but they decided to stop it due to concerns over potential resale issues, scalpers basically, and the negative impact that could have on the brand's image. Apparently, they faced similar problems with past Pokemon prizes where limited edition toys were being resold at hugely inflated prices online.
Ah, okay. Trying to avoid that headache.
Exactly. An analyst actually sees this as a potential long-term opportunity for brand improvement, suggesting that by addressing these issues proactively, McDonald's Japan can strengthen its brand integrity and customer loyalty in the medium to long term, even if it means sacrificing some immediate sales from a popular promotion.
Interesting perspective. So preemptive measures to protect the brand image long term. Moving over to Europe quickly, what's the picture like in their stock markets? Were they as volatile as Japan or the U.S. tech scene?
No, actually. Major European markets showed only minor fluctuations today. Pretty quiet. There was some profit-taking which capped the upside after the STOXX 600 index that covers 600 major European companies hit a 5-month high the previous day.
So a bit of a breather after the high.
Exactly. We saw some buying interest in defensive stocks, the steadier names, like Nestlé in food, AstraZeneca in pharmaceuticals, investors seeking stability. Conversely, oil-related stocks and defense sectors saw some declines. But overall, Europe's markets were pretty quiet, almost as if they were holding their breath, especially with that highly anticipated Jackson Hole conference just around the corner.
Right, everyone waiting for Powell. Okay, now let's talk about China's stock market, because the report highlighted an unusual change in bank deposits there, and it sounds like it could be quite significant. What exactly is this deposit relocation phenomenon that's occurring, and how massive is this shift of funds into the stock market?
It's truly a phenomenon, yes, and reminiscent of past speculative market conditions in China. It definitely warrants close attention. So in July, for the first time in 20 years, new bank loans in China actually decreased.
Decrease. That's unusual.
Very, yet at the very same time, non-bank deposits, now these are funds typically held in trusts, wealth management products, or securities accounts, basically money outside traditional savings accounts.
Uh-huh.
Those non-bank deposits rapidly increased
Right.
by a staggering 2 trillion yuan.
2 trillion yuan in 1 month.
Yes. It signals a massive reallocation of funds, effectively a movement of capital directly from traditional bank savings and into the stock market. And the proof is pretty stark. New A-share securities account openings in July surged by 70% year on year. That totals nearly 2 million new individual investors jumping into the market in just 1 month.
That's incredible. So money is essentially just pouring out of savings accounts and straight into the stock market because people can earn more there. That sounds a little risky, doesn't it? What's driving this yield gap that's making the stock market so much more attractive compared to traditional banking?
It definitely carries significant risks, yes. And China's market history offers some very clear warnings about this kind of thing. The attractiveness, though, is quite stark for the average investor right now. 1-year fixed deposit rates at major banks in China, they're currently below 1%.
Below 1%, wow.
Yeah. Contrast that with the dividend yields of state-owned enterprises, the SOEs, which are essentially being encouraged by the government to strengthen shareholder returns. Companies like, say, Industrial and Commercial Bank of China, ICBC, they're currently offering dividend yields of over 4%.
Okay, that's a huge difference. 1% is 4%.
It's a compelling difference if you're an everyday investor. Why keep your money earning less than 1% in a savings account when you can potentially earn over 4% just from dividends in the stock market, let alone any potential capital gains?
That yield gap is certainly huge. What triggered this current stock rally, though, and this dramatic shift we're seeing? Was it just the low deposit rates?
The primary trigger seems to have been a series of economic measures announced back on September 24, 2024. The People's Bank of China, the PBOC, lowered its reserve requirement ratio and policy interest rates. That signaled a clear push for easier monetary policy.
Okay, government stimulus.
Yes. And crucially, they also introduced new loan frameworks specifically to facilitate share buybacks, essentially encouraging companies to buy their own stock, which supports market activity and valuations. Since those measures were implemented, the Shanghai Composite Index has risen a notable 36%.
36%, that's a strong run.
It is. And beyond these direct policies, you also have the spread of the, AI boom narrative globally, and also the restructuring of large state-owned enterprises in China. Both have drawn attention and helped fuel the rally, creating a sense of maybe a new economic era.
This sounds a bit like history repeating itself, though. China has had pretty dramatic stock bubbles before, right? Let's talk about those echoes of the past, the 2007 and 2015 bubbles. What were the key characteristics of the 2007 bubble, and what can we learn from it?
You're right to bring up history. The 2007 bubble, which saw the Shanghai Composite hit its all-time high, that was driven by a period of really exceptional high growth. China had just joined the World Trade Organization, WTO. Plus, there were significant state-owned enterprise reforms happening. This combination ignited a personal stock investment boom. A real frenzy, you could say.
The frenzy.
Yeah. The Shanghai Composite Index, it was around 1,000 points in mid-2005. It increased roughly sixfold in just over 2 years. The critical insight there is that the market became entirely detached from fundamentals. It was fueled by pure speculative fervor.
What popped it?
The turning point was the listing of PetroChina on November 5, 2007. It briefly became the world's largest company by market cap, but it plummeted almost immediately after listing. That effectively poured cold water on the entire bubble. And then, of course, the global financial crisis, the Lehman shock, in 2008 delivered the final devastating blow.
Okay, so a classic speculative bubble burst. And what about the 2015 bubble? That one seemed to be more government-fueled, didn't it?
Yes. The 2015 bubble was indeed heavily influenced by government economic measures. It came at a time when real estate prices were starting to fall, and China's economic slowdown was becoming more evident. In November 2014, the PBOC cut interest rates. Then a whole succession of measures followed, designed to prop up the sluggish stock market. By June 12, 2015, the Shanghai Composite had hit 15,166 points. That was 2.6 times its low point from January 2014. The critical characteristic of this bubble was the explicit, almost celebratory encouragement from the government itself.
Wait, so even the government was actively cheering on the stock market. That's quite something. And what exactly is leveraged trading for an everyday investor in this context? Because that seems to have played a huge role in the 2015 crash.
It's quite astonishing, isn't it? The Communist Party's official newspaper, the People's Daily, actually published an article stating that 4,000 points is the start of a bull market. Yes, that only fueled the rally further, leading to a kind of national fervor where everyone was encouraged to buy stocks. Now, as for leveraged trading for an everyday investor, imagine you want to buy stocks, but you don't have enough cash to buy as many shares as you'd like.
Okay.
Leverage trading means you borrow money maybe from a brokerage, maybe from another lender to make those investments. If your investments go up, your gains are magnified because you're using more capital than just your own.
Sounds good if it goes up.
Right. But it's a double-edged sword. If the investments go down, your losses are also magnified, and you're still on the hook for the borrowed money.
Ah, the downside.
Exactly. In 2015, this was done extensively through something called off-site financing. Think unregulated, shadow lending, to individuals who wouldn't normally qualify for legitimate margin accounts at a brokerage. Even banks got involved, selling financial products that allowed this kind of circumvention, highly speculative lending.
That sounds incredibly risky.
It was. The bubble ultimately burst when authorities, finally realizing the immense speculative nature and the inherent systemic risks, cracked down hard on these unregulated transactions. That triggered widespread forced selling, margin calls, and a very rapid market collapse.
That makes the risk crystal clear. So if we look at the current situation in China now, what are the most striking similarities and maybe differences to that 2015 bubble? Because the critical insight here isn't really if China's market is in a speculative phase the data strongly suggests it is. The real question maybe is how Beijing, armed with the lessons from 2007 and 2015, might attempt to engineer a soft landing this time, where past attempts led to sharp crashes. That feels like the real high-stakes gamble for global markets.
That's a brilliant way to frame it. Because there are definite similarities, yes. We're again seeing an economic downturn. We're seeing government-led support through rate cuts and stock price measures, large-scale restructuring of state-owned enterprises designed to boost their attractiveness. The emergence of new individual investors, particularly those maybe in their 30s and 40s, who are seeking alternatives to a struggling real estate market, that's also a direct parallel. And critically, margin buying balances in Shanghai. They are nearing the 2015 bubble levels again, exceeding 1 trillion yuan.
That margin number is worrying.
It is. It's not just a number. It indicates a market fueled by borrowed money, amplifying both gains and, more dangerously, potential losses. That's a key red flag for speculative excess.
So, plenty of reasons for concern given the past. But what makes this time different, if anything? And why might Beijing hope for a different outcome this time?
The differences are really crucial to understanding Beijing's, as you put it, high-stakes gamble for a soft landing. This time, there's arguably greater diversification of investment destinations through listed exchange-traded funds, ETFs, including those linked to Hong Kong stocks, gold, even corporate bonds.
So money isn't only going into mainland stocks.
Right. It means money isn't solely flowing into A shares with the same intensity, perhaps. And critically, new individual traders appear to be more aware of liquidity risk and volatility, perhaps having learned from past cycles, suggesting maybe a slightly more informed, though still speculative, approach.
Bit more caution, maybe?
Possibly. The most critical difference is the explicit memory of 2015. Beijing is acutely aware of the dangers of unchecked leverage and uncontrolled speculation. Whether they can manage to deflate this potential bubble without triggering a sharp crash, maybe by slowly tightening credit or issuing strong warnings rather than a sudden jarring crackdown, that remains the ultimate test. It's a really delicate dance between maintaining investor confidence and preventing a runaway market.
So it's definitely not an exact replay, but the ingredients for serious volatility are certainly present. What's the outlook then? Is this overheating likely to intensify, or can Beijing actually pull off a soft landing this time?
Well, it really remains to be seen. Will the overheating intensify, or can Beijing successfully engineer a managed cooldown? This current situation is undoubtedly a crucial test for the future of China's capital markets, and frankly, a fascinating case study for global economic observers. The authorities are aware of past excesses, that seems clear, But the underlying drive for investors to seek higher yields, especially in a persistently low interest rate environment, is incredibly strong. It makes it a very difficult balance to strike.
Definitely one to watch closely. Okay, let's move on to broader macroeconomic trends and some specific sectoral insights. Let's start with a quick snapshot of key U.S. economic indicators from mid-August. What's the overall health check looking like?
Certainly, the data shows, well, a mixed picture, but generally resilient. Weekly petroleum inventory stats showed a decrease in crude oil and gasoline stocks. That often suggests strong demand or maybe tightening supply. Though distillates, like heating oil, saw an increase.
Okay. What about housing?
Housing in July saw starts up, but permits were slightly down, and the home builders index also dipped a bit. Suggests some caution from builders, maybe due to higher interest rates impacting affordability.
Makes sense.
Retail sales showed modest growth. Consumers are still spending, but perhaps a bit more cautiously. Industrial production saw a slight decline, hinting at some manufacturing slowdown. Consumer sentiment dipped as well. Suggests a subtle erosion of confidence, maybe.
Any bright spots?
On a more positive note, the New York Fed Manufacturing Index that gauges manufacturing activity in that region, it improved significantly. And, as we discussed earlier, initial jobless claims remained relatively stable and low. That reinforces the idea of a resilient, albeit softening, labor market. So yeah, picture of moderate growth overall, but with some definite areas of caution mixed in.
Okay, a mixed but resilient picture for the U.S. Now, on to global shipping and supply chains. I saw some headlines about container shipping rates from China to the U.S. dropping, down to a one-year, 8-month low, apparently, now at $1,759 per 40-foot container. That seems counterintuitive, though, because July reportedly saw the first year-on-year increase in Asia to U.S. shipping volume in 3 months, reaching a record high of 1.92 million TEUs. First off, what's a TEU? And second, why are shipping rates dropping if volume is actually up? That feels like a paradox.
That's a great observation, and it really highlights a crucial dynamic in global trade. It affects everything, right? From the price of consumer goods to a country's trade balance. So first, a TEU stands for 20-foot equivalent unit. It's the standard measure for container ship capacity. Basically, it represents one 20-foot long shipping container.
Okay, so 1.92 million of those is a lot of cargo.
An enormous amount of cargo moving, yes. Now, as for why rates are dropping despite that specific volume bump in July, it's a nuanced situation. That July increase was largely seen as a temporary surge. It came shortly after that U.S.-China tariff suspension agreement back in May.
Ah, so a rush to beat potential tariffs.
Likely. Some goods probably rushed through the pipeline to beat potential renewed duties, but that recovery was pretty short-lived. Overall, the underlying year-end cargo demand seems to remain weak, primarily due to those persistently high U.S. tariffs that discourage imports from China.
Okay, so underlying demand is weak.
Right, and this weak demand, coupled with the fact that shipping companies ordered a lot of new, larger vessels during the pandemic boom, that has led to an intensified vessel surplus, meaning there are simply more ships available than there is cargo to fill them efficiently.
Too many ships, not enough stuff.
Essentially, yes. Even with a recent 90-day tariff extension, demand recovery remains limited, and many retailers may have already pre-stocked their inventories, reducing the immediate need for new shipments. What's also fascinating here is a significant shift in procurement away from China.
Oh, where to?
Countries like Vietnam, India, Malaysia. They're experiencing significant growth in their shipments to the U.S. This diversification also plays a role in the overall rate dynamics by spreading cargo demand maybe more thinly across different routes.
So what does this mean for me, the listener?
Well, lower shipping costs could eventually translate into slightly lower prices on imported goods, or at least help retailers maintain their margins without raising prices as much as they might otherwise have to.
Okay, that perfectly explains the paradox. Thank you. Shifting gears now to electric vehicles. I saw a statistic that EV battery production capacity globally is apparently 3.4 times the actual demand. That's led to a 30% price drop. What kind of headwinds does this massive oversupply create for Japan's domestic production efforts, especially when they're trying to ramp up?
It's a significant challenge, a huge challenge, really, for any country attempting to establish or expand domestic EV battery production, and that includes Japan. With such massive global oversupply, 3.4 times demand, as you said, battery prices are plummeting.
Makes it hard to compete.
Exactly. This intense price competition makes it incredible.
Okay, let's talk about the Japanese banking sector next. We're seeing regional banks like Tochigi Bank mentioned in the reports extending gains. It seems part of a broader trend of active buying in regional bank stocks, kind of following the bigger mega banks. What makes these smaller regional banks suddenly attractive? Is it just following the big guys, or is there something specific about their situation right now?
It's a bit of both, actually. But there are very specific drivers that make regional banks particularly compelling right now. Firstly, yes, eased global economic concerns have provided a general tailwind for the entire financial sector that helps everyone.
Uh-huh.
But more specifically for Japanese banks, there's growing speculation about additional Bank of Japan interest rate hikes.
Ah, higher rates help bank profits.
Exactly. Higher interest rates translate directly into increased lending interest income for banks, including the regional ones. They can charge more for loans. This directly improves their profitability. The fact that the 10-year long-term Japanese government bond yield has touched around 1.6% also provides a supportive environment for bank stocks. It signals a return to higher interest rates generally.
Okay, so the rate environment is helping. Anything else?
Yes. Furthermore, there have been recent reports, notably an alliance mentioned between SBI and Tohoku Bank. This is fueling speculation about industry realignment, consolidation in the regional banking sector,
Mergers and acquisitions.
potentially. This kind of M&A activity can create buzz and drive short-term buying in related stocks as investors anticipate potential synergies or perhaps increased market power for the surviving entities.
Okay, so a combination of macro tailwinds from rates and specific industry dynamics like potential consolidation. Got it. Finally, let's touch on real estate in Japan, specifically Tokyo. This number jumped out at me. Tokyo's 23 wards saw secondhand condominium prices hit a record high of 104.77 million yen in July. That's for an average 70 square meter apartment. Over 100 million yen. That's incredible. What's driving that kind of jump, especially for secondhand properties when overall economic growth might be mixed?
It is indeed an astounding jump. As you said, over 100 million yen on average. That marks the third consecutive month over that level. And it's a staggering 38.7% increase year on year for that average 70 square meter unit.
So what's the driver?
The primary driver appears to be strong buyer demand, which is acting as a substitute for a decreasing supply of new condominiums.
Ah, less new supply pushes buyers to secondhand.
Precisely. The number of new condos sold in Tokyo's 23 wards in 2024 was actually down over 30% from the previous year. That unmet demand gets pushed towards the secondhand market. And we're seeing a significant rise in what are colloquially called okuzion condos, priced over 100 million yen.
Okuzion.
They now make up 15.5% of listings on some major housing information sites. That's a rapid expansion from just 1% back in 2015.
15%. That's a huge change.
It is, and in the prime central wards, like Minato and Chiyoda, these okuzion properties now account for over 50% of all listings.
50%. Half the listings are over 100 million yen. That's a huge shift in the market makeup. So who are these buyers pushing prices up so high? And what else is contributing to this surge in high-value secondhand properties?
Well, a significant factor is the inflow of investment funds from both domestic and foreign wealthy individuals. These buyers often look for stable assets. They recognize Tokyo real estate as a valuable, tangible investment, especially given the low interest rate environment for traditional savings.
Oh, safe haven buying, maybe.
Partly, yes. Additionally, the asset effects from rising stock prices are playing a role. Individuals who have seen increased wealth from the stock market are now able to invest in higher-priced properties. They're channeling some of those gains into real estate.
Okay, but is this happening everywhere in Japan?
No. And that's crucial. It's a polarized market. While Tokyo and Osaka are seeing these dramatic price increases, many other major cities surveyed, places like Yokohama, Saitama, Kobe, actually saw price declines in July.
Oh, interesting. So a real split.
A very clear split.
Yeah.
It indicates a divide between investment-driven areas where wealthy individuals and funds are flowing in, and more resident demand areas where prices are much more sensitive to local economic conditions and affordability for the average buyer.
That provides a really clear picture of the Japanese real estate market polarized and investment-driven at the high end in major cities. Now, let's bring the focus back towards consumers and different investment strategies people might be looking at. First up, SPACs, special purpose acquisition companies. I definitely remember hearing about those a lot a couple of years back, but then they seem to just disappear. Why are they suddenly back in the conversation now after such a sharp slowdown?
You're absolutely right. The SPAC market cooled dramatically after its huge boom in 2020-2021, almost vanished from the headlines for a while. But now, yes, they are indeed gaining attention again, showing clear signs of revival.
What's driving the comeback?
The main reason seems to be that investors are gradually adopting more of a risk-on attitude. This is largely amid those growing expectations of Federal Reserve interest rate cuts we talked about earlier.
How do rate cuts help SPACs?
Well, when the cost of borrowing money is expected to be lower, it generally makes riskier assets, those with higher potential returns, but also higher potential losses, more appealing. The hurdle rate for investment success is effectively reduced.
Okay, risk becomes more attractive.
Right. And the data backs this up. There have been 81 SPACs lifted in 2025 already. That actually exceeds the total of 57 listed in all of 2024. Even the SPAC and new issue ETS, which tracks these kinds of companies, is up about 4% year to date.
So real momentum building.
It seems so. We're even seeing the return of the so-called SPAC king, Chamath Palihapitiya.
Oh, I remember that name.
Yes, he's launching a new $250 million SPAC, specifically targeting AI mergers. It's his first venture since he had to liquidate 2 SPACs back in 2022 due to failed mergers. And this broader risk-on trend, it's also visible elsewhere. Look at cryptocurrencies. Bitcoin trading at very high levels, even hitting a record high of over $124,000 on August 13th.
Wow, okay. So it's a combination of lower interest rate expectations, making riskier assets more attractive, and then some big names jumping back in, maybe bringing back some confidence. But I also hear a word of caution being sounded about their return. What should our listeners be aware of with SPACs?
Absolutely. While the excitement might be back, the inherent risks certainly remain. And perhaps they're even amplified now by the sectors these new SPACs are targeting. The nonprofit group Better Markets recently issued a strong warning. They said reviving SPACs could become even more speculative and risky.
Why more risky now?
They noted a particular increase in SPACs that are specifically targeting cryptocurrency companies, which are themselves, highly volatile and speculative. There's also a growing awareness of their, let's say, political colors, as seen with former President Trump's sons being involved as advisors for one particular SPAC.
Okay, so added layers of risk.
Right. For you, the listener, the key takeaway is that while SPACs can offer a path to potentially high returns, they also come with significant structural risks and generally less regulatory scrutiny compared to traditional IPOs. It's definitely a buyer beware situation, especially in a risk-on environment where speculative fervor can sometimes override fundamental analysis.
That's an important caution, thanks. Let's turn to retail giants now. We seem to have a tale of 2 very different stories playing out. With TJX, they own TJ Maxx and Marshalls, and then Target. TJX's stock rose strongly, 8.1%, hit a new 52-week high. They raised their full-year earnings forecast. Q2 sales beat expectations, comparable sales grew 4%, plus they announced a big $2.5 billion stock buyback plan, and management said current tariff levels wouldn't significantly impact earnings. Sounds like all good news.
Pretty much a stellar report for TJX, yes.
But then, Target's stock plummeted 10.6%, even though their Q2 revenue actually beat forecasts. Their same-store sales, however, fell 1.9% year-on-year, and the company maintained a cautious full-year revenue outlook, still projecting a low single-digit decline. Plus, the announcement of a CEO change triggered additional selling. Market voices apparently suggesting investors desire an external, fresh perspective for profit improvement. So one discount retailer is soaring, another is struggling, even with good headline revenue numbers. What's the main takeaway for listeners here? What's the strategic lesson from this contrast?
This is really a vivid illustration, isn't it? That even within a seemingly similar sector like discount retail, the underlying business model, the strategic execution, and how consumers perceive value, those things truly matter, especially in a dynamic economic environment like this. The main takeaway for you, the listener, is probably that headline revenue alone isn't enough. Underlying sales trends and a clear strategic direction are paramount to investor confidence.
So digging deeper than just the top-line number.
Exactly. TJX's strength lies in its off-price model. That resonates really strongly with consumers seeking value, especially during periods of prolonged inflation. They're consistently delivering solid comparable sales growth, they're proactively returning capital to shareholders via those buybacks, and their ability to manage tariff impacts, which they publicly confirmed, that further reinforced investor confidence.
Okay, so TJX is executing well on its model. What about Target's issue?
Target, on the other hand, despite beating those overall revenue expectations, saw a really key metric, same-store sales decline. That signals softness in their core business model, or maybe customer engagement at the store level. The market clearly penalized them for that weakness, and also the apparent lack of a strong immediate turnaround plan,
Hmm.
which is exemplified by that desire for external leadership change.
Right, the CEO change.
Yeah, it just underscores that even with overall good revenue, if your core growth drivers are faltering, investors will react negatively.
That's a very clear distinction that highlights the nuances within retail.
Thanks.
And speaking of price changes impacting consumers, Sony Interactive Entertainment announced it will raise PlayStation 5 prices in the U.S. starting August 21st. They're citing a challenging business environment and specifically mention the influence of Trump administration tariff policies. The standard model goes up $50 to $549.99. The PS5 Pro will be 7% more expensive at $749.99. Interestingly, no changes announced outside the U.S., and it's noted that rivals like Microsoft and Nintendo have also reportedly raised prices due to increased import costs from tariffs. So tariffs are still directly impacting consumer goods, even something as popular as a gaming console. What does this tell us about the broader economic impact of these policies?
Indeed, it really demonstrates that while the Fed might view tariffs as having a slow pace of inflationary pressure on the macro scale, they can have very direct, very noticeable impacts on specific industries and consumer goods, especially high-value imports like electronics.
Right, you feel it on specific items.
Exactly. Companies like Sony, Microsoft, and Nintendo, they rely heavily on global supply chains for components and manufacturing. They are directly feeling these increased import costs due to tariffs. They are then essentially forced to pass these increased costs on to consumers, at least in the markets most affected by the tariffs, like the U.S., where these price hikes are being implemented.
And that affects wallets.
Absolutely. This ultimately affects consumer purchasing power, consumer decisions. It shows that even if tariffs don't trigger broad, widespread inflation, they can certainly make specific, desirable products more expensive for the average shopper.
Okay. Let's touch quickly on fund wrap services. We're seeing that sales for the four major fund wrap companies in Japan actually saw their first increase in 4 quarters, up 4.4% to 515.9 billion yen in the April-June period. What exactly are these services and who typically uses them? Why the renewed interest now?
Right, fund wrap services. They're essentially a way for investors to completely entrust the management of their assets to financial professionals. So instead of picking individual stocks, bonds, or mutual funds themselves, clients signed a discretionary investment contract with a financial institution.
And the institution does the work.
Yes. The professionals handle the asset allocation, the rebalancing, all the investment decisions based on the client's specific risk profile, their financial goals, their time horizon. These services primarily target affluent clients. They often come with higher minimum investment amounts and management fees, but they offer significant convenience and expert oversight.
So why the increase now?
The recent increase in sales suggests a renewed interest from wealthier individuals in delegating investment management. Perhaps it's a response to ongoing market volatility, the complexity of the current economic landscape, or maybe just a desire for professional guidance during uncertain times, allowing them to focus on other things. It indicates maybe a flight to professional management for those with significant capital to invest.
Makes sense. And finally, an interesting tidbit that came up about President Trump's personal investments. Reports indicate he purchased over $100 million in U.S. corporate and municipal bonds through more than 600 transactions since his inauguration in January. These included bonds from major financial institutions, Citigroup, Morgan Stanley, Wells Fargo, and tech companies like Meta and Qualcomm, some of which could potentially benefit from his administration's policies. Is it common for a president to be making personal investments on this scale while in office? Does that raise any eyebrows in terms of potential conflicts of interest? What are the rules around this?
It's certainly a topic that draws significant public scrutiny, yes. While U.S. federal officials, including the president, are required to disclose their assets and financial transactions to the Office of Government Ethics, that's for transparency, the sheer scale and frequency of these reported transactions are, well, noteworthy.
Over 600 transactions is a lot.
It is. The reports generally don't provide exact purchase amounts or specific sales details, which does limit full transparency on the precise nature of these holdings and how they change over time. And while President Trump has stated his businesses were transferred to a trust operated by his children, his asset disclosure reports apparently indicate that various revenues from these holdings ultimately contribute to his personal assets.
So potential conflicts.
Well, it definitely raises questions about potential conflicts of interest, especially when investments are made in companies that could be directly or indirectly impacted by administrative policies or regulatory decisions. It's a very fine line, isn't it, between personal financial management and the public's expectation of unbiased decision-making in high office. where even the appearance of a conflict can potentially erode public trust.
A complex issue indeed. Okay, let's wrap up our deep dive now by looking at the bond market and commodity prices before we get to the overall market outlook. What's been happening with bond dynamics, both in the U.S. and Japan?
In the U.S., the benchmark 10-year Treasury yields closed slightly lower at 4.29%. A recent 20-year U.S. bond auction was described as solid. That's market jargon, basically indicating strong investor demand when yields are relatively high.
So the U.S. can still borrow easily?
For you, the listener, it means the U.S. government can still find plenty of buyers for its debt even at these attractive interest rates. That's crucial for funding its operations without putting undue pressure on borrowing costs across the wider economy. Domestically, in Japan, bond futures rebounded somewhat. This was partly due to some bargain hunting after an 8-day fall. Investors saw value in the dip. It was also supported by those lower U.S. long-term rates we mentioned.
And Japanese rates themselves.
Japanese long-term rates actually touched 1.605%. That's a 16-year, 9-month high. Makes them quite attractive to buyers who see investment appeal at that kind of level.
But is everyone buying?
Well, there's a nuance. The recent Bank of Japan bond purchase operation and a separate, somewhat weak 20-year Japanese bond auction. They suggest some lingering investor selling interest too, and maybe some caution over supply-demand conditions, meaning that while some are definitely buying at these higher rates, others are still hesitant or maybe looking to sell.
Okay, so if rates are high, that's generally good for bond buyers looking for income, but it also signals some hesitation or caution in the market. How should listeners interpret that dynamic, that mix of strength and caution?
That's a keen observation, and it really highlights the ongoing tug-of-war in the bond market. When bond yields are high, yes, it means bonds are offering a better return. Think of it like getting a better interest rate on your savings account, inherently attractive for new buyers. However, the hesitation, those somewhat weak auction results, they indicate that while some investors are keen to lock in those higher yields, others are still cautious.
Cautious about what?
Could be various factors. Uncertainty about future interest rate movements, will they go even higher, making today's bonds less attractive later? Concerns about inflation eroding the real returns over time, or simply supply-demand imbalances if too many bonds are being issued at once.
So what's the takeaway?
For you, the listener, it means that while there are appealing entry points for bond investments right now, the market isn't unilaterally bullish. There's a nuanced assessment of risk and reward at play. It indicates that bond markets are actively pricing in these evolving economic expectations.
That's very helpful context. Now, quickly looking at commodity markets, what have we seen there? Any significant movements?
In commodities, yes. Crude oil, specifically West Texas Intermediate, or WTI, it rebounded, rose 1.4% to $63.21 per barrel. This was supported by a tightening supply-demand outlook and also those declining U.S. crude and gasoline stocks we mentioned earlier, signaling robust energy demand.
Okay, and gold?
Gold prices also saw a rise, up 0.9% to $3,388.05 per troy ounce. That was driven primarily by dollar weakness. A weaker dollar makes gold cheaper for international buyers and also its traditional role as an alternative, safe haven investment during times of uncertainty.
And platinum?
Platinum also saw some gains, partly due to maybe a sense of undervaluation compared to other metals, and also just a technical rebound from recent lows.
Okay, so some strength returning to commodities, reflecting shifts in both supply-demand dynamics and global currency movements. Now for the big picture. What's the overall market outlook, both near-term and medium-term, particularly thinking about the Nikkei in Japan, given its recent movements?
Okay, near-term first. We should probably expect some continued fluctuations. Choppiness in the Nikkei. Investors are likely to remain cautious, particularly ahead of Chair Powell's highly anticipated Jackson Hole speech. That could provide new guidance on global monetary policy direction. They're also still reacting to the recent overheating we've seen in the market. So short-term, there could definitely be some more profit-taking and volatility.
But the medium-term outlook for Japan sounded more optimistic in the reports, despite that immediate caution. Ichiyoshi Asset Management's president Aquino apparently believes Japanese stocks still have considerable room to rise, potentially reaching 48,000 yen on the Nikkei within 6 months. What supports that bullish outlook, given the immediate caution and the recent softening we discussed?
That optimism, it's rooted in a pretty compelling scenario, one that links Japan's fortunes directly to the global economic landscape, particularly the U.S. Aquino anticipates a strengthening U.S. economy. potentially fueled by significant economic stimulus measures under a possible future Trump administration.
Ah, the U.S. connection again.
Right. A robust U.S. economy historically provides a powerful tailwind for Japanese equities, given the strong trade and investment ties between the two countries. So the expectation is that Japanese stocks would rise in kind, basically following the U.S. market's potential upward trajectory.
And the fundamentals support that.
He projects that the Tokyo Stock Price Indexes, or TOPIXs, earnings per share EPS, a key measure of corporate profitability, could rise to 190 yen. And he sees a tolerable price-to-earnings ratio, PE ratio, of 18 times.
So what does that mean in simple terms?
For you, the listener, it means he sees corporate profits in Japan growing strongly enough to justify higher stock prices, even from current valuation levels, which would allow for that significant potential upside for the Nikkei average you mentioned. It's really a vision of sustained growth driven by both domestic improvements, things like better corporate governance in Japan, and a favorable global economic environment, especially a strong U.S. economic engine.
It's fascinating how interconnected everything is. As we continue to navigate these dynamic financial waters, it's just so clear that understanding the interplay of all these forces is more crucial than ever. From the complex dance between Fed policy and employment data here in the U.S., to those intriguing similarities and differences of China's market today compared to its past bubbles. The nuanced volatility in the tech sector, and the surprising resilience and strategic shifts happening in various sectors globally. It's a lot to track.
It really is.
We've seen how decisions made in Washington can ripple right across the Pacific, how subtle shifts in consumer behavior can shape the fortunes of retail giants, and how even geopolitical discussions about things like tariffs can impact the price of your next gaming console. It truly is a tapestry woven with countless threads, and identifying those connections, hopefully like we did today, helps us all become better informed. Thank you for joining us on this deep dive. We hope this has given you valuable insights into the day's most important financial stories and maybe sparked some new thinking. Until next time, stay informed and think critically.